Hey, it's Navy Dowdy here in the Chicago area in the Midwest and the great United States. The topic of this week's tax tip is nothing up my sleeve. That's a reference to an old cartoon where Bullwinkle the moose was about to do a magic trick and would push up his fur as if it was a shirt and say, "Nothing up my sleeves," and presto, and pull a rabbit out of the hat. It would never be a rabbit that came out of the hat, of course. The trick always went wrong, and instead he would pull out Rocky the flying squirrel, his cartoon partner in his cartoon adventures. Sometimes when the IRS is defining, or more so not fully defining, tax policy and rules, they do something that has an unexpected presto result, and something else comes out of the hat. Normally, these unintended consequences are exploited right away by tax planners and attorneys all over the country, like piling on a loose football in the middle of the fourth and goal play. At least until the news of the unintended benefits gets back to the right ears in Washington, and then the service will pass guidance and plug up that hole in the code. An example of this would be conservation easements. The IRS has given a tax break for deed restrictions in the form of conservation easements for a long time. They just never considered that smart attorneys would create LLCs and syndicated conservation easements so that many people could share in one deduction. To date, although they have threatened to plug up the unintended benefits loophole and have treated them as listed transactions, they're still quite legal and going on all over the U.S. It seems that since the Obama administration left office, there's been little time for the government's list of things to get done or fixed, as they have been busy dealing with crisis after crisis and burning through mountains of money in the process. One of the more recent loopholes in this case, because of all the rules not being worked out yet, is cryptocurrency. Because it's being used as an exchange and still is not called a security, it doesn't come under the 30-day rule that stocks and bonds do for loss harvesting. With a stock, people who sell a share at a loss must wait 30 days to repurchase that stock if they intend to take a loss on their income taxes. When they sell the stock at a profit, they pay either a short-term or a long-term capital gains. With crypto, we have gone halfway. The IRS has decided that sales at a profit will be taxed the same way as a stock, but they have so far neglected to say, what if you sell your crypto at a loss, that you have a 30-day wait to repurchase that same currency. Therefore, if a person bought Bitcoin, for instance, at $45,000 and can now sell it for $42,000, then they can harvest a loss on their taxes, even though later that day or week they have repurchased that same coin, and if the value goes back up to $45,000, they've not lost any value at all. Of course, trading crypto has costs that are higher than the cost of selling or trading stocks, and risks not related to the financial markets that have been established for a century. So those costs and risks may negate some of the tax harvest value. Or the Robinhood level trader might be in a super low tax bracket where capital gains and losses are a non-event from a tax planning perspective. But for many, taking advantage of crypto selling when the value is down seems to be an unintended benefit within the tax code, at least for now. The service will likely fix that loophole soon, but with the giant cash fires to attend to, who knows how long that might take. I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth. And get together with your tax planner. It's near the end of the year.